Welcome back to the channel. If you're looking to build a reliable passive income stream or create a dividend-focused portfolio that can survive any market condition, you're in the right place. Today, we're diving deep into dividend investing strategies using ETFs like SCHD and JEPQ, and how taxes, extra income, and clever portfolio choices can drastically affect your results. By the end of this video, you'll understand exactly how much you need to invest to generate $70,000 a year in dividend income, how taxes impact your earnings, and how to optimize your portfolio for maximum efficiency. Let's get started. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with SCHD, a popular dividend ETF. If your goal is $70,000 in annual dividend income and SCHD is paying a yield of 3.6%, before accounting for taxes, you'd need around $1.95 million invested. That's purely from dividends and doesn't include any salary or other income. Now, here's where it gets interesting. In 2025, the first $48,350 of qualified dividends will be taxed at 0%, while the remaining $21,050 will fall into the 15% tax bracket. That reduces your $70,000 dividend to roughly $66,150 after taxes, giving you an effective tax rate of just 4.6%. Pretty efficient, right? But wait, there's more. Most investors overlook the standard deduction. In 2025, single filers can subtract about $15,000 from their taxable income. This means if you make $70,000 in dividends, you'll only be taxed on $55,000. Applying the same tax brackets, only $6,650 is taxed at 15%, bringing your total tax bill to around $1,000. That's an effective tax rate of just 1.4%. So if you want a clean $70,000 after tax income, you just need to slightly increase your dividends by about $1,000. That translates to investing roughly $30,000 more in SCHD, bringing your total investment to approximately $1.97 million. Now, let's consider a more realistic scenario for most investors. You earned $30,000 from another source, like a job, Social Security, or a pension. Your total dividends now only need to generate $40,000. Here's the catch. Extra income affects how your dividends are taxed. The 0% tax bracket for dividends gets filled first by your other income. So instead of $48,350 being tax-free, only $18,350 of your dividend income benefits from the 0% rate, and the remaining $21,650 is taxed at 15%. To generate $40,000 in dividends, you'd need about $1.1 million invested in SCHD. Considering the standard deduction, your effective tax bill would now be around $3,247, bringing your effective rate to 4.6%. To hit a post-tax $70,000 total income, you'd need roughly $110,000 more invested, for a total of about $1.2 million. This scenario is much more realistic for everyday investors and demonstrates how combining other income sources with dividend income affects your tax efficiency. Now let's talk about JEPQ, a high-income ETF with an 11.2% yield. To earn $70,000 before taxes, you'd only need to invest around $620,000. That's nearly one-third of what you'd need for SCHD. High-income ETFs like JEPQ distribute dividends monthly or even weekly, making them excellent for tracking income and compounding growth. Unlike qualified dividends, JEPQ's distributions are taxed as regular income. Using 2025 federal tax brackets and the $15,000 standard deduction, your effective tax rate is roughly 10%, bringing your after-tax dividend income to about $63,000. To net $70,000 after tax, you'd need roughly $705,000 invested. With an extra $30,000 in other income, only $40,000 in dividends is needed, requiring about $357,000 invested in JEPQ. The remaining dividend income fills higher tax brackets, bringing your effective tax rate down to 5.2% and total income to around $66,350. One final concept is return of capital, ROC, which is a powerful tax strategy. With ETFs like SPYI or GPIQ, ROC distributions reduce your adjusted cost basis, ACB, instead of being taxed as income. For example, if you invest $100,000 in a fund with a 10% ROC dividend, your ACB drops to $90,000 after the first year. The second year, it drops to $80,000, and this continues until your ACB reaches zero. During this time, the distributions are not taxed. Once the ACB hits zero, future distributions are taxed as capital gains. This is a clever way to receive high dividend yields while deferring taxes, effectively giving you a tax advantage over standard dividend-paying ETFs. To wrap up, SCHD is great for qualified dividends and tax-efficient income, but requires larger investments to hit big income targets. JEPQ offers high monthly income and requires significantly less capital, though dividends are taxed as ordinary income. Taxes, standard deductions, and extra income sources dramatically affect effective dividend yields. High-yield ETFs combined with return of capital strategies can significantly boost after-tax income. Tools like PropPix AI help build diversified portfolios tailored to your strategy. By understanding how different ETFs, tax rules, and income sources interact, you can structure a dividend portfolio that's both efficient and reliable, whether your goal is $70,000 a year or much more. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.